I'm Taylor Britt. I am the Vice President of Marketing, and I will be your host and tour guide through today's webinar. Mainly, we're going to focus on agency growth strategies, and we're going to go into a couple of different ways we can help your agency grow. We're going to discuss level-funded health plans. We're also going to get into a conversation about gap insurance. And then, of course, we will talk about MERP strategies, also known as medical expense reimbursement plans. A lot of good information here for you guys today. So I'm going to go ahead and pass it over to Josh to introduce himself.
Thanks, Taylor. Josh Pizek here, Director of Sales for the Midwest and West markets at the Difference Card. So I work with your senior consultants, really from Pittsburgh all the way out to California. So excited to bring this to you today. Hopefully give you some new ideas and strategies to help grow your agency and business in 2025. Ashley?
Great. Thanks, Josh. Good afternoon, everyone. My name is Ashley Doobie. I'm the Senior Director of East Markets, and I manage the Senior Consultants team really from New England down to Florida. So thanks for joining today. Chris?
Thanks, Ashley. Hi, everyone. I'm Chris Calderon. I'm the Chief Revenue Officer for the Difference Card, responsible for our sales and marketing efforts, and really excited to talk to you today about how we can help you to grow your agency using some pretty unique alternate funding strategies that we're going to walk you through. So over the next 20 minutes or so, we're going to go through some strategies to help you differentiate your agency. We understand that it's a highly competitive market that you're in, and you need to come up with creative solutions that your competition is not showing in order to help you stand out in this marketplace. So one of the ways that we've found that producers are able to win new business and grow their agency is by using unique funding strategies, coming up with better benefit strategies at a better price. And we're going to walk through level funded, gap funded, MERP funded, all those different types of strategies pretty quickly today to show you all some creative solutions to create a little wedge between you and the competition out there in the market. Before we get into those solutions, let's just start with some of the issues that we see. As I'm talking to other producers out there in the market, account executives, vice presidents, brokers, they often are using relationship-based selling, which can be a great strategy to win new business, but sometimes it's tough if maybe you've got a relationship with the CFO and the incumbent knows the owner, and you just need something a little bit extra, that wedge, to push that sale over the edge and get them to go your way. So relationship-based selling is a great start, but you need a solution that can actually get the business over to your agency. And then I'm sure all of you have an amazing value proposition. You've got great service, but I'm seeing a lot of similar service stories out there in the market. So again, you have to find something that's different to help your agency win that new business. And then especially in the community rated market, 50 and under or 100 and under in certain states, all of the medical plans, right? They're cookie cutter, community rated. You need to be coming up with different solutions because you can't negotiate, right? The rates are the rates in some of those states. So you need to have a different strategy, an alternate funding strategy in that community rated market that can help differentiate your agency and win that new business. All right, before we launch into the solutions, we want to hear from all of you. What strategy have you used successfully to win new business and grow your agency? So give us some idea of what's been successful for you in the past as you're winning new business. Is it sticking fully insured and just making plan changes? Maybe you've used level funded health plans in the past. Do you like gap funding, secondary insurance? Have you used the Difference Card MERP funding strategy, or do you go full freight self-funded? Is that your approach?
Yeah, we're seeing a lot of diversity in our answers here. It's going to be really interesting to see which one pulls ahead as the main strategy that our attendees are using. We'll give everyone just a couple more seconds here to cast their vote, and then we will share our results with the audience. All right, let's see what we ended up with here. Okay, so it looks like the majority of our participants, about 40%, are using level funded health insurance. Coming up next is self-funded. Third, we've got making changes to the fully insured carrier or a plan change. And then lagging behind a little bit is the MERP and gap plan / secondary insurance. So really interesting here.
Yeah, really interesting results. And I think we've got an order today that's going to work for you all. We're going to hit level funded health plans first pretty quickly. So that might be a refresher for maybe the majority of you. Then we're going to dive into gap funded plans, and we're going to finish with a lot of strategy on MERP funding and how that can help you all win some new business. So hopefully you all get something out of this from a new strategy and solution perspective. And we wanted to just share with all of you some of the success that over the past 12 months our producer partners have had. We track how much new business our producers win using, this is just the MERP strategy part of this solution. And over the past 12 months, we've seen almost 200 new BOR wins using this type of an approach. That equates to over $8 million in new revenue for the producers that we work with. So we know this strategy works. Alternate funding is a great way to win new business. We've seen it work. This is some great results we've seen just within the last 12 months. So let's talk about the whole financial funding spectrum from a health insurance perspective. There are a lot of options out there, and we'll lay them out kind of from high risk to low risk, just to give you a sense for all the different strategies that we see in the market. So starting out fully insured, which amazingly still about 55% of the market is still in a fully insured plan, very low risk. They get an invoice, they pay that invoice, they don't have to worry about any of the claims expense, but they pay an incredibly high fixed premium cost for that type of plan design and that funding structure. As we start to move to the right, now you're taking on maybe some lower plan design, lower premiums, so you're lowering that fixed cost, but you're taking on maybe a little bit of risk. So gap funding, we're maybe buying a high deductible plan, putting a gap plan on top of it, taking a little bit of exposure there with a secondary insurer. Level funded takes it another step up, actually goes to self-funded paper, takes on some claim exposure and gets some surplus share back. MERP funding, you can do that with either level funded or fully insured plans, getting a really low fixed premium cost, taking on a little bit of exposure and then saving a lot of money. And then that ultimate extreme of going self-funded, where you're paying your own claims, you're purchasing stop loss to protect yourselves, but you can save the most money with that type of an approach. So I'm going to start by jumping into the level funded side of things. And for those of you that have used this strategy before, it'll be a quick refresher, but level funded gives the customer the ability to share in some of the surplus. If their claims are not as high as the carrier expected, well, then they're going to get some money back. We see anywhere from a third to 75%, probably 50-50 is the typical share of surplus that we see in a level funded health plan. And technically, these plans are written on self-funded paper, so they save some money in premium tax. They do save some carrier margin dollars, and the customer gets some of that money back at the end of the year. So it's a way to lower that fixed premium from an insurance perspective. This is just an interesting chart. 100 life groups spending $1 million in fixed, fully insured premium, helping them to lower that fixed premium by moving to a level funded health plan can definitely create some savings. And in addition to the lower premiums, they're going to get the potential for a refund if they run better. A group that runs really well over time, has low claims costs, can have some pretty significant long-term savings with this type of an approach. Level funded can work really well, and it can be used down in some of the smaller group segments, whereas self-funded really doesn't make as much sense below 100 lives. Level funded, we see a lot in that 50 to 99 segment especially. So a little bit more about just the structure and payment model that we see with a level funded health plan. Typically, it's a self-funded plan, but it looks and feels a lot like fully insured. The customer pays a fixed monthly amount, and they pay some of that towards fixed premium, and some of it goes into a claim account, and then they get some of that claim account money back if they run well and they have a surplus at the end of the year. They're also putting some money away in reserve so that if they ever terminate this type of arrangement, they've got some reserve for those run out type claims. So it can be, again, a great way to lower fixed cost, provide some savings over time, and a lot of customers need savings. As we look at the rising cost of healthcare over time, this has become a big problem for many employers. It's the single biggest line item on a lot of employers' balance sheet behind payroll. and it's just increasing by big increases year over year, 9, 10, 15% in some cases. So this is definitely a pain point that you all can use to help solve a problem for that customer and hopefully win their business. And level funded plans can reduce that fixed premium. Just a watch out on the risk side, though, because it's self-funded, sometimes you can see a higher increase from a cost perspective at renewal if the group has high claims. So for those groups that may have not the best risk profile, level funded can be a problem at renewal time if they're not running that well from a financial loss ratio perspective. But overall, great way to lower health plan costs, and one of the strategies we've seen successfully work for our producer partners. So I'm going to pause there and pass it over to Josh, who's going to take you through the next strategy of gap plan funding.
Thank you, Chris. Not real surprising that the gap plan solution in our poll revealed that it's not super popular out there. I'd say we as salespeople at the Difference Card run into a couple of groups per month that have some sort of gap plan in place. And it works. It allows the client to pay less premium to their major medical carrier. So you reduce that fixed cost to the major medical carrier. The gap plan comes in and provides additional benefit for the employee to help cover certain costs for that higher or that lower cost, lower premium plan that you're using. So there's in the financial protection through paying premium for that type of plan. So a number of administrators do this. We see a few clients a month that have a gap plan in place and can provide alternative solutions for gap plans. But really, what does a gap plan typically cover? It's major medical. It's your hospital stays, it's your surgeries, your outpatient procedures, maybe lab work. Usually gap plans are not as specific for paying for your routine exams like doctor visits, specialist urgent care, prescriptions. So a lot of exclusions also can be built into gap plans. So you just need to be conscious about what that plan covers and what it does not cover. And from a member perspective, we also see some limitations and some confusion with how gap plans work. Because it is secondary insurance, you usually are having the presentation of a second ID card to your provider. So one, the employee has to understand that they have, say, the Blue Cross plan and then a secondary gap plan that they need to present to their provider. Provider then needs to file 2 claims. We need to get coordination of those benefits between the 2 carriers. And what we hear a lot is that the member experience is just confusing. There's a lot of paperwork, there's a lot of balanced bills, there's back and forth, and just hard to understand in general. Some of those gap plans can have pre-existing condition exclusions built into them. So again, we see some pitfalls in gap funding. We recognize that it is a step to alternative funding. But I'd like to focus on and shift to MERP now and discuss some of the differences I think and we think that the Difference Card can bring to the table through the existence of a medical expense reimbursement plan. We really market our platform and product as a stepping stone to self-funding. So we can work with a fully insured or a level funded group, and you can take advantage of lower cost paid to the carrier and then come in with a Section 105 medical expense reimbursement plan that can do very specific things: buy down copays, buy down deductibles, coinsurance, prescription deductibles, prescription expenses. And then very unique to our platform specifically is that we have reinsurance that we can tie to our platform. So we open up the client to liability. At the end of the day, they only pay for the claims that are incurred. So they're not paying additional premium. They're not losing reserves if reserves are sitting there at the end of the year, but they have protection built in through a policy that we have with Assurant. I think Ashley's going to talk more about that coming up. But this is really a stepping stone, a taste of self-funding, almost a little miniature self-funded plan that attaches to that lower cost carrier plan. To further illustrate the model, the clients that we work with today, they're dumping if you're fully insured, they're dumping all of their premium to the carrier, and they're letting the carrier manage all of those dollars, and they never get any of that back. So our model, again, really allows them to buy less insurance from the insurance company, usually do that with the same insurance company. Don't change your network, don't change your doctor, but then put in a layer of a benefit funded by your employer, again, ultimately funded only when needed. And then that usually results in somewhere between 10 and 20% savings for the client overall. And the nice thing about the difference card is that those savings can be shared with the employees. So with a MERP, we do enjoy a couple of specific advantages over just your typical HRA. So when we work with a client that has an HRA in place today, I love showing the client how we can kind of take them to the next level. Two things I'll point out here is that the MERP allows for really a streamlined purchasing from the carrier. Illustrated on the left would be the structure of buying one plan from your carrier, and let's buy the lowest cost plan that's appropriate for the network, for the HMO, the PPO, the EPO, the high deductible plan, whatever is appropriate for that group. Let's buy the lowest cost plan. And then we can build multiple options off of that. So the difference card is the administrator is really the one that's providing that ultimate benefit to the employee. Again, using the plan from the carrier, let's get them into the doctors, get them into the networks, and then let's figure out a way to give them a benefit when they need it to bring down those costs. One other advantage that a MERP has over an HRA is that employee and employer can contribute to the cost of the plan. So we're going to issue a premium equivalent rate. If you worked with us in the past, you've seen those on our proposals. Those are rates that, because we are Section 105 medical expense reimbursement plan, can be shared between employee and employer. And I think most of us know that if it's just a standard HRA, it's got to be a one-to-one pairing, both from plan design and then 100% employer only funded. So I want to talk specifically about a strategy that when we get into the financials, a private sector company recently adopted. They were looking for savings. They didn't have a horrible renewal, but looking for savings and wanted to maintain the basic structure of the plan, the basic experience of their employees going to a doctor and continuing to pay a copay. But they didn't like the premium and the total costs that were associated with their $30 copay plan that had a $1,000 deductible tied to it and a relatively low out-of-pocket maximum. So working with our broker partners, we help you go back to that carrier of choice, identify a plan that will work well for our platform in this strategy. And what will happen is all of those costs are going to go up. You're going to buy a plan that's in the middle and the lower part of the slide here, that the copays increase. You have a higher doctor copay, specialist copay, the deductible goes way up, the out-of-pocket maximum increases. But in turn, as we all know, when you do that, your premium decreases. So first step with difference card, let's lower that premium as much as possible. Let's lower that fixed cost that goes out the door. Let's then take those savings and figure out a way through our platform to give back and do that very specifically. So you'll see this card issued to the employee, issued to the spouse. Kids are tied to both of those cards. We come in, we educate, we put a sticker on the card so it reminds what they have, but they can then use this now really like a gift card. So if I just use one example, moving from a $30 specialist copay to a $75, well, that's a $45 difference, of which our card can recognize that you're at a doctor, and it can work for that $45 difference. So member presents this insurance to their doctor. They present the difference card, not secondary insurance. It's a payment mechanism. So we empower our members to get their benefits right there at the point of service. It just cuts down on all that back and forth. Their understanding of this is, oh, I've got a credit card and another form of payment that I can use for a portion or maybe all of this copay that's being charged to me. So $75 charge from your doctor, your specialist. A $45 swipe on the card equates to a $30 out-of-pocket expense for the member. $30 goes on your own form of payment, or we have FSA capabilities on our card too. If John Smith, in this example, were to put FSA aside, he could swipe this card one time, $75. 45 comes from his employer MERP bucket, and then 30 comes from his FSA. So just a way to go in and kind of surgically dissect this low-cost plan that you're using from the carrier to ultimately give a customized benefit to the employee once they use it. So why would you do this? It's financial savings. So this, like I said, private sector company, they wanted to maintain that look and feel of the plan, but they needed savings. In their industry, they were looking at potential layoffs this past fall. And they weren't facing a horrible increase. So a 3% increase in this market wasn't bad. We need to show them, though, how we can reduce that fixed cost. And really, that's where we come in at the 1.1 million. So that gets them into the low-cost carrier plan. It pays for their difference card admin, the cards, the reinsurance. All of our fixed costs are built in there, and it's a small PEPM. It's not premium, say like a gap plan. It's a PEPM in the form of fixed costs, and then everything else from there is claims. So the claims are the claims. Most of our clients want a steady amount that they fund in for their claims and just do that once per month, of which we can accommodate. So in this scenario, 1.2 million was funded out at maximum for the plan year, automatically guaranteed savings of 115,000. But in the event that they didn't use all of the 1.2 that was funded, those reserves are setting in a specific account that's designated per client by the difference card and establish that implementation. Big difference here between level funded and difference card. Any reserves setting there at the end of the year goes back to the client 100%. That can be rolled over into the following plan year. It can be extracted from the plan and be used in other forms of the business. And that's ultimately what this private sector client did with their guaranteed savings. And I know they're planning to do in the event of a surplus at the end of the year. We show a 5-year projection. This is really just in an effort to illustrate, let's give the carrier low premium, as little premium as possible, probably still expect some sort of increase year over year, but the compounding effect of a lower amount really adds up quickly. And we give this exhibit each year at renewal and really prove our worth. So that as a strategy, like to launch into the next poll question. And Taylor, I think you got controls here. You're gonna take over from here.
Yeah. Thank you, Josh. So we're curious, what plan design strategies are your clients using that is helping to fuel your agency growth? Are you seeing first dollar coverage paid at 100%? Maybe you're seeing copay first plan designs, a lot like that one Josh just talked about. Or are you seeing your clients use those HSA qualified high deductible health plans? What strategy is working for your clients currently? Give everyone just a couple more seconds here and then we'll close it out. All right. So really interesting here. Only 18% of you are using first dollar coverage paid at 100%. Our winner was the HSA qualified high deductible health plans. And then right there in the middle was that copay first plan design. So I'm really excited that only 18% of you are familiar with first dollar coverage because I've got Ashley here. I'm going to turn it over to her and she's going to walk you through how that would work.
Great, thanks, Taylor. So Josh went through the first case study that really talked about our traditional bread and butter MERP plans. If the client's on a copay plan today, keep them with the same platform that they're familiar with and really just cover the changes and benefits with the MERP. The second case study was actually a nonprofit that I'm going to talk through, and they were dealing with a pretty difficult medical renewal. And this was a case where the broker, it was a prospect for them. They were actually able to get the meeting because the group was getting a pretty significant increase and their current broker is asleep at the wheel and hadn't shown a lot of creative strategies. So I'll give more about the story and how the broker won this case. But on the left-hand side here, we have their current plan. So this group was on a very rich copay plan today, $30 primary care and specialist copay, $1,000 deductible. We had worked with a broker and priced out this middle plan, this base plan here, with a $6,000 high deductible. And this plan received a pretty significant discount in premium from the insurance carrier. And the feedback that we heard from this nonprofit is that they wanted to keep benefits rich, as traditionally their employees were not very highly compensated, and then also make the plan easy to understand, as they've received just feedback from the employees in the past that they couldn't really understand how the medical plan worked. So essentially what we did is we purchased a $6,000 deductible from the insurance carrier, and the employer funds the first $5,000 of that deductible. So for the employees, it's a significant improvement in benefits. If they have $5,000 and less worth of medical care, they have no out-of-pocket cost towards their insurance. They will only have skin in the game after that $5,000 has been met, and they will pay that last $1,000 of the deductible. So the nonprofit found this strategy really interesting, especially when they were trying to attract and retain employees, just showing that, hey, we have great medical benefits, and this is really easy to explain to employees how this works. The card works the same way. Each employee would get one as well as their spouse, and they're able to swipe the card for that first $5,000 worth of medical as well as pharmacy care. As I mentioned, this group was dealing with a pretty difficult medical increase, almost 20% here. There's a lot of back and forth on what do we do with this? We don't want to pass the cost on to employees. This is a pretty big financial increase that we just cannot sustain. So the group was looking at increasing their costs about 20% to 2.3 million if they had stayed on that same course and renewed as is. The revised fixed cost, so that $6,000 deductible plan from the carrier plus the difference card service premium, brought their fixed cost down to 1.8. And revised max cost actually brought them below what they were paying today at about 0.5 point. And the revised max cost, so really the worst case scenario here, was 1.9 million. So for this broker who was working with the prospect, they were able to go out there and say, hey, worst case scenario, we're still going to bring you to about a flat renewal and guarantee you savings of almost $400,000. So that's really how the broker was able to show a creative strategy and win the BOR on this account. Same effect here, really the compounding will come into play year over year. Even if the group does get a renewal increase next year, it's at a much lower number. So the CFO loved this slide, found it really attractive that over a 5-year time period, they were projected to save almost $2.3 million while improving benefits. That difference guarantee, Josh mentioned it. We do partner with an A-rated division of Assurant on this. So they are the financial backing behind this. We rolled this out in 2018 and it's been very popular. Essentially, it's a promise to pay if the claims exceed a certain amount. So we're financially backing the numbers that we are projecting for claims, which has been really popular. Most of our groups do elect this difference guarantee. We have a few different banking models. Our traditional banking model is what we call claims-based funding. This is almost a pay-as-you-go model. So if you think about from a client's perspective that they move to this bronze plan with a carrier, their health insurance premium is going to be a lot less every single month. Most clients would put that money aside to help fund the MERP claims. With this model, the client would only fund the claims as incurred, which is great because they took advantage of the cash flow and kept that on their books until people actually went into the doctor and received care or had a surgery or whatever it may be. The downside of this model is that there was a fluctuation in claims from month to month based on actual utilization. So we still have a fair amount of clients that do go this solution as they want to keep that money on their books until the claims actually come in. And with this model, there's an annual reimbursement on the guarantee. If the plan does run hot, they would get that reimbursement back at the end of the plan year. The second model that we rolled out, we heard really from our nonprofit clients, our municipalities, that they couldn't deal with the fluctuations from month to month in claims. They wanted to essentially set it and forget it. So we rolled out this monthly budget funding solution. Same type of arrangement, a bank account is set up. It is funded by the employer. So they pre-fund the claims at maximum every month. It goes into an account. If the plan runs well and there's a surplus, they get 100% of that surplus back. So for a client who's concerned about fluctuations from month to month, with this, they know exactly what they're being billed between the service premium as well as the claims component, and there's an upside potential to get money back at the end of the plan year. You'll also see pretty comprehensive reporting that's included with the MERP solution, and this is on any size group. So traditionally, when you're thinking about reporting from the carrier, it's really, depending on market, groups 100 plus that you will receive access to data. With groups on the MERP, even if they're 30 live, you'll get pretty detailed reporting trying to see where exactly care is utilized. The left-hand side showcases a management report, and we can actually see how many people received care at an office visit, some of the specialties even in there. We have podiatrists in there and how many prescriptions they picked up. So this helps for future planning with renewal, where we can see utilization and see how the plan's running for the strategy and how to design the plan in the future. We also include the monthly budget reporting. So this is important just to see how the plan is running. Here's a sample of one. It's in the black, which is great. This group is running well and they are at a surplus, so they're expecting to get money back at the end of the year. So just to wrap it up, when should you quote the MERP? Really, this is a great solution in that mid-market space, 25 enrolled, upwards of 1,000 enrolled. If the group is fully insured or level funded today, if they have a high level of benefits, so if you go into a prospect and they have a platinum plan, that's a perfect fit for savings on our end. That's really where we can provide savings and keep benefits intact. And then we have a lot of employers that have been improving benefits. So whether you're offering office visit copays at no cost, improving deductibles, doing that difference card funds first model that I reviewed, and improving benefits for employees, that's a great way, especially in the small group space where you can't customize plans and typically they're canned, to offer different benefits out there.
All right, thank you, Ashley. That was really, really great. I'm gonna send you guys some information in the chat here, but if you are curious in requesting a quote, you could reach out to your dedicated difference card sales consultant. If you're not sure who that is, I've linked a page to our website where you can find who represents your region and your market. And then of course, you can always go directly through our website. Feel free to shoot us over any groups you might have that are experiencing a high renewal, or if you're just curious, you might be surprised in what we can do. We just need a couple of pieces of information here: medical rates, enrollment by tier, your plan summary designs, and broker compensation PEP amount. So feel free to bring that over and we're happy to work up even an illustrative proposal for you guys. I know we are at time, but if you would like to hang on, we can answer any questions that may have come through here in the last couple of minutes. And then of course, I will be sending around the recording to everyone if you do have to jump. All right, Chris, it looks like we've got a question that just came in. Are there carriers, this is from Brett, that would not allow this strategy? He's thinking about Cigna, for example.
Yeah, Taylor, we really work with every carrier out there in the market. Cigna's a good example. We actually have file feed integration with Cigna on a lot of customers. They typically like to do that on the larger group segment, but a lot of business with Cigna. And we haven't run into a carrier yet that has just said, no, you can't do this. We have a lot of partner carriers out there that provide file feeds to us and have really good discounts and decrements. And I know we've got some of that information on the website. Thanks for putting that in the chat, Taylor.
Yes, yeah. I'm going to make sure that you guys have a link here over to our integrations page so you can see who we do work very closely with. And then I just noticed my other message went to just the host and panelist. It would probably be helpful if you guys had it as well. So I'm going to drop it back in there for everyone.
Perfect.
Let's see. It looks like Matthew Cole was kind of following up on the thread, Chris, regarding HSA qualifying plans. Any feedback for him there on writing plans with HSA qualifying and if there's any restrictions?
Yeah, we have lots of groups that are doing this on an HSA platform. Especially there was another question about, well, what if we've already gone to a high deductible plan? That's very common now, or maybe you have a $2,000 deductible today and they want to keep that plan as a qualified high deductible health plan so they can contribute to an HSA. So what we've seen in the market is that it still works. You can go to a $7,000 high deductible health plan, get that premium savings, and then just back end fund, let's say the last $5,000 in that example, that maintains the qualified status of the plan. And from what we've seen, many carriers are still open for that strategy to work across the country. There was a question, I think, also from Wayne about Employee Navigator, and that is one of our partner eligibility vendors. So we're in the Employee Navigator marketplace if you look us up there, and that's definitely one of our integrated ben admin vendors. We do a lot of business with them.